Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. Hello, everyone. Welcome to the Greater Central Florida Multifamily Investors Group meeting, where we focus on investing where it makes sense. I'm your host, Ismael Reyes, and this show is for people investing in Central Florida or wanting to partner with others that are investing, primarily multifamily, but not necessarily only multifamily. We're here today to talk about, like I mentioned, Florida multifamily investing, the forecast for 2022, where we look for real estate investments that make sense. We have to start with location. We want to focus on the big three minus our formula: population growth, economic growth, low or lowering unemployment. And you want to subtract the risk, both political at the macro level and at the micro level, criminal. With these in mind, it's no secret why many people are interested in Florida, specifically Central Florida. It is hot right now. I can't find a deal. I'm hoping somebody out there has a deal that they want to share with me, because it's just hard to find good deals because everybody's chasing them. But I don't want you to take my word for it. Our special guest, Carl Whitaker, Director of Research and Analysis for RealPage Inc., where he blends in his passion, that's a key word, for geography, economics, and teaching to foster a practical, applied understanding of apartment trends and forecast expectations. Prior to joining RealPage, Carl worked as a consultant with Catalyst Commercial, an economic consulting firm based in Dallas. Carl received a bachelor's degree in secondary education and a master's degree in applied geography from the University of North Texas. Carl, I'm not going to belabor this, man, but feel free to give yourself a bigger pat on the back. I got to tell you, and I mentioned this to you before, a lot of folks really liked the last time I had you on the show, which, if my memory serves me correct, was December of 2020. So it's good to have you back after a good year and some change to make us smarter on what's going on here in Central Florida and Greater Central Florida.
All right, well, thanks, Ray. And like Ray said, my name's Carl Whitaker. Really appreciate everybody attending today, and looking to get some good conversation, some good dialogue kicked out of this. Just additional introduction. I actually am currently based, or the RealPage office is in Richardson, Texas, which is a suburb of Dallas, and I'm based up in McKinney, Texas, which is used to be the more northernmost suburb in the region, but now it's starting to get further north and further north. It's just crazy to see all the development around here. So really appreciate the introduction. Let's see, I will get my screen share going just to make sure everyone can see, should say a U.S. and Central Florida apartment market update. Looking good?
Yep.
All right, perfect. Well, as far as what we have prepared for today, I've got about 45 slides altogether. Some of them take a little bit longer, some of them will be a little bit shorter. So I'll probably talk for about 45 minutes. What I'd probably prefer, and Ray, I'll yield to you here, but what I found works best is if we answer questions as they come up. It just tends to help the flow of conversation a little bit more. But again, if you prefer to have questions afterwards, I'm happy to do that as well. That's up to you.
Really, it's up to you. As long as you're good with that, I think that you're right. That helps a lot with just making sure we keep the people interested. And believe me, I got some questions, but I'll try not to take over the show here.
Perfect. Well, with that in mind, then let's go ahead and just jump in. Again, feel free to ask any questions as they come up. Happy to answer those through the flow of the conversation. I'll try to keep an eye on the chat, but sometimes it's kind of hard when you're on the deck here. So let's go ahead and jump in. I'll start first with a national overview. About half of my slides are looking at the nation overall. Then we get into some Central Florida specific discussion. What I'll say before getting into the Central Florida specific data is that basically take everything I say at the national level, multiply it by about 1.5, and then apply it to Florida. I mean, it's just incredible what we've seen in that state over the past 12 months or so from an apartment performance perspective. Ray and I were joking earlier whenever we first jumped on the call that this time last year we were a little bit bearish on, say, Orlando. Had some questions on how the tourism economy recovers, knowing that COVID was obviously impacting that segment of the economy more significantly. And here we are today saying Orlando is a top 5 market in the country. I mean, that's just really a testament to the broader Florida landscape, and really any part of the state you go into, whether it's the Panhandle, whether it's Jacksonville, whether it's South Florida, you can't find a soft spot in Florida overall right now. Just truly, truly incredible stuff happening across the state. So with that said, my first chart here, looking at annual demand across the country, what we're tracking here is essentially the net absorption of apartments. And in 2021, 675,000 units were absorbed. And that number by itself is impressive. But considering that that number beat the previous annual peak by more than 60%, RoPage has been tracking this data almost 30 years now. And to see that number surpassed by 60% is a really strong testament to the strength and the quality of demand right now. On top of that, it's embedded in this chart. You can see that 140,000 units absorbed in fourth quarter. That was the strongest fourth quarter we've ever seen on record as well. Historically speaking, especially in some of the colder weather markets, you don't tend to get a lot of demand in fourth quarter. There's just not as much movement, schools in full session. It's just, you don't have as many people moving around in the winter. But even in some of those markets, we saw really solid demand. Now, Florida, a little bit aseasonal. You get some of that snowbird demand. You get some of those smaller markets that tend to get an influx around October all the way through March. So what we saw was a really strong fourth quarter. And again, just accolades all around when it comes to demand across the country. Now, looking at individual market performance, what this graphic is showing you is net absorption between March 2020 to today. In other words, if you look at the apartment market pre-COVID, how many units in that market were occupied then versus how many units are occupied today. And what really stands out on this chart is that every major market that we track has more units occupied now than it did pre-pandemic. New York and San Francisco were some of the last markets to recover, a little bit more hard hit in those instances, but places in Florida and really in the Sun Belt in general have had exceptional demand. Now, this x-axis here, looking at the total change in apartment count, for instance, DFW has about 70,000 more occupied units today than 6 quarters ago. Houston, 50,000. That's your x-axis. Now, your y-axis gives you a sense of scale on a more relative basis. A market like Charlotte or Austin, being smaller, will never have the same nominal demand as what you see in Houston or DFW, but that doesn't mean that it on a relative basis isn't as impressive, and that's exactly what we're seeing. So places like Orlando, almost 10% more occupied units today than you had just a few quarters ago. What really struck me too is whenever you start looking at some smaller markets, you'll notice that I've called out some of the Florida metros where demand has really, really surged in a big way. Now, again, these are smaller markets. They'll never have the same nominal demand, but on a percentage basis, places like Palm Bay, Lakeland, Deltona, Daytona, Cape Coral, Fort Myers, a little bit further south. I went ahead and lumped that in here just for the sake of this discussion. Places have had an absolutely incredible demand. Now, of course, the question is, well, what's driving that? Well, for one, Florida and Texas, Georgia, North Carolina, et cetera, these states have been getting a lot of population growth, a lot of in-migration, really for the better part of the past decade. Now, COVID has accelerated some of these pre-existing trends. That's probably pulled forward some demand. In other words, folks that maybe lived in New York that were probably going to relocate to Florida, 2, 3, 4 years down the road, maybe they just sped that decision up in 2020 and into 2021. And in turn, that's fueled a lot of demand. But, the Florida economy has been recovering at a faster pace than most parts of the country. You've had a lot of renter income growth in this part of the nation too. That's the same in some of these other Sun Belt markets. So really accolades all around for many of these Florida metros. Now, the last component, and this is where things get a little bit more muddled, the last component is that clearly some of this trend has been driven by the work from anywhere crowd or the work from anywhere phenomenon. So folks that maybe lived in Boston or New York, you know, were looking to move elsewhere, whether it be temporarily, maybe sometimes permanent. I think the question for some of these markets like Cape Coral, Sarasota, Palm Bay, et cetera, is how much of this demand is quote unquote temporary. In other words, how many of those people will end up moving back to their home metro versus how much of that is permanent. And unfortunately, I don't have a clean answer just yet. I don't think anybody really does. I think the trend that I would really watch out for, or the trend that I would really key in on, is which one of these markets had some sort of unique or pre-existing economic anchor prior to COVID, and how many of these are just your flavor of the month markets. In other words, how many of these are, I used the analogy a while back, how many of these are beanie baby markets that you're going to have a huge flow, a ton of interest, and then the interest just fizzles out over time. And I think the real distinction will be it's many of these markets that, again, have a true inherently unique demand driver are going to be the ones that have some staying power. So all that's looking at new lease demand. I know I'm talking fast. There's a lot of slides to go through. Any questions before we continue? If not, then I will keep on rolling. Okay. All right, so that first few slides is looking at new demand. Part of the equation that we can also look at too, though, is renter retention. In other words, how many of your expiring leases are being renewed by residents? And what we've seen really for the better part of the past decade is that resident retention has slowly crept up. You know, at the start of the 2010s decade, it was pretty common to have, let's say, 40 to 45% of your residents would renew their lease upon lease expiration. But what we've seen here recently, before that, we've seen that trend creeping up over time. But what we've seen here recently is a really big influx of residents electing to renew leases. And candidly speaking, this has been one of the things that surprised us. I would have been willing to bet almost anything that resident retention would have peaked last year during the spring and summer months, simply because you couldn't move around. You know, you just didn't have the ability to. But what we actually saw was late this year, resident retention hit an all-time high, and you have fewer residents moving out than ever before. Now, one of the things driving that, and I'll talk about this in a little bit, it's kind of a chicken and an egg situation. You have fewer residents moving out because there's fewer available units to move into, but because there's fewer available units to move into, this retention rate goes up. So I don't know which comes first, but it is an interesting phenomenon and something that we're looking at, something that also probably points to the simple fact that we need more multifamily housing across the country. Clearly, there's a supply shortfall. Maybe not the case in a handful of metros, but generally speaking, there is a supply shortfall across the nation. Now, looking at occupancy rates, this is just an incredible number. As of December 2021, 97.5% of the nation's apartment stock was occupied. So RealPage reports or tracks that there's roughly, let's call it 18.5 million multifamily units across the country. That number is actually a little bit bigger, but we generally tend to track the larger properties. We don't tend to track like the smaller duplex or 4-unit multifamily assets. But nevertheless, apartment occupancy, let's call it 97.5% at the end of the year. Looking at that rate, that means there's fewer than 500,000 unoccupied units across the country. There's 330 million plus people that live in this nation. So like, just do the math on that and see how incredible it is that we've had this much demand and occupancy sitting at this level, especially considering the economic backdrop. And I'll talk a little bit more about the economic backdrop later, but just really, really incredible demand across the nation. I think this is another good chart that shows that. This is the RealPage tracks, let's call it roughly 300 metros across the nation. And only 20 markets sit below 96% occupancy. The fact that we're using 96% as our lowest range here is just almost unfathomable. You know, it would have been 5, 6, 7 years ago that this is probably your upper range. Maybe you have a handful of markets that are at 97%, but we have fewer than 2 dozen markets that are below 96% occupied. Most of those markets as well are going to be on the Gulf Coast or some of your energy dependent markets. There's a handful of those that are in the Dakotas, Williston, North Dakota, for instance. So some volatility obviously follows the energy driven markets. Some of the other markets are just your slower growth Midwest, small Midwest markets. And then you have a handful of kind of by the wayside college towns, Pullman, Washington, and Bowling Green, Kentucky, just smaller college towns, not your big marquee names. Conversely, whenever you look at the right side of the axis here, you can see that 33 markets are greater than 99% occupied. So some really strong occupancy rates as we rounded out 2021. Now, what follows that tight of occupancy? Well, it's not surprising to see that rent growth follows occupancy levels whenever they're that tight. Now, again, candidly speaking, this time last year, whenever we had this presentation, we were forecasting really good rent growth across the country. We were probably looking at 7 to 8% rent growth. I don't know that anybody could have foreseen rent growth on new leases peaking at, let's call it 17, 18% back in the fall months. And even at the end of the year, we're looking at 16% growth on new resident leases. Again, keep in mind, whenever you look at Florida, that's actually a lower estimate. Tampa, Orlando, some of those smaller markets like Lakeland and Sarasota, those numbers are actually higher in Florida. But just across the country, the average is 16% on new leases. Now, whenever we get to the forecast, we'll dive more into this, but I do want to go ahead and mention it now. Our new lease rent growth, we think 2022, that number starts to moderate. For one, it's just going to be hard to see rent growth match 17% again. We're forecasting roughly 10 to 11% rent growth across the country. However, the side of the equation that we're not looking at is renewals. And you see that renewal rent growth is accelerating at 9.5%, let's call it, as of December. That number we expect will continue to grow next year. And the reason for that is, for one, you have more residents than ever staying in place, as we mentioned earlier. But also, if you look at a loss to lease number, in other words, what's that gap between a resident that's in place today versus if they were to move out into a property across the street, assuming all else is equal, same unit size, same rent, that new lease across the street is going to be running 12 to 13% greater than if you decide to renew your lease. Historically, that number is closer to 3 to 4%. So our view is that renewal rent growth continues to accelerate next year. New lease rent growth starts to ease back a little bit, and that closes that loss to lease number into a more, maybe not quite to historic norms, but it starts easing closer to what that number looks like. And then across the product spectrum, whether it's Class A, Class B, Class C, whether it's renewal or new leases, a lot of strength out there, really solid performance across the board. I'll talk about some of the drivers for this in just in a few slides, but really across the product spectrum, performance is really, really great. Now, getting into some more of the market specific stuff, what you'll notice about this is looking at new lease trade out in 2021. I should have put a label up here. This is full year 2021 numbers, but to me, there's 5 distinct groups of markets on this page. Your first bucket here, and this is just looking at the top 50 metros or what we call the top 50 metros. Those are just the 50 biggest markets in the country. What stands out to me is that on this far left group, you basically have Florida and the desert Southwest. Well, what's common about those markets or those states? Those are the areas where a lot of people moved to in 2021. That was already happening pre-COVID, but again, COVID certainly accelerated some of those population trends. And actually at a conference earlier last week, that is, I really liked the term. There's this population shuffle that's happening, this shuffling of population. And at least thus far, the short-term winners have been the desert Southwest and Florida. Now, in the second group of markets, a little bit less geographically tight, but what you'll notice is, to me at least, a lot of rebounding Southern California metros. So maybe some folks that moved out of, let's say, LA to Phoenix, maybe some of that moving back into LA, maybe some of that going back into Orange County, for instance. But you also see I heard earlier a lot of folks mentioning Georgia, the Carolinas, et cetera. You'll notice that it's a lot of those Sun Belt states that are growing really fast continue to get the strongest lease trade out, at least on new leases. Now, in this middle bucket, a little bit harder to come up with a storyline here. I guess what I would say is it's generally blue collar markets, markets that maybe don't have a lot of the tech employment or a lot of the, really big wage numbers. These are going to be more blue collar driven. And then lastly, you start getting into some markets that are maybe some of those slower recovering coastal markets, Seattle, San Francisco, Boston, maybe some places where there's some more political headwinds from an apartment ownership perspective. You've just got some more headwinds coming into the picture there. And then lastly, your final bucket is just generally your slower growth markets in normal years. I like to consider many of these markets like St. Louis, Columbus, Kansas City, et cetera. Those are kind of like your leadoff hitters. They're not going to hit you a lot of home runs, but during recessionary periods, they don't tend to strike out a lot either. And we saw that exact trend happen over the past 12 months. Those markets were actually at the top during the peak of the pandemic, but now have settled back to roughly below the national average. Just again, the nature of those economies, the nature of those markets. Now, that loss to lease number that I mentioned earlier, again, that's essentially saying the difference between what a resident would pay for a new lease versus if they elected to renew that lease. That loss to lease is the highest it's been since the recession, or since the Great Recession, I should say. So we think that number starts to normalize and starts to come back again closer to 3 to 4%. It's not going to happen this year. It takes time for those leases to turn. I'm sure I'm preaching to the choir here, but we all know rent rolls don't change overnight. It takes time for that to happen. So we think that loss to lease starts to come back down into more normal patterns through this year, but it's certainly going to take more than just this year to get that back to a pre-pandemic level. And then lastly here, this is just kind of packaging everything up, looking at where rent rolls are today, and really encouraging to see that rent rolls are growing at essentially their fastest pace in 5-6 years. What I would also point out though, and I think this is going to feed itself into, or this is going to lend itself to some of the investment conversation that we have later. But if you look at last year, late 2020, early 2021, that's going to be about the time that you've had the full year of your rent roll to quote unquote stabilize. But what I would point out is that even at the worst of the recession, rent rolls across the country were only declining by about 1%. And if you take out New York, San Francisco, Boston, DC, et cetera, and just look at the Sun Belt markets, that number was actually at like positive 2%. So I think one thing that apartments have proven over the past 12 to 24 months is that they do tend to be resilient during downturns. And I think that is pulling a lot of capital into the multifamily arena, especially so with so many questions surrounding office investment. Right now is a tricky time to really pinpoint what office investment looks like. Retail already had some challenges even heading into COVID. Starting to see some rebound in retail investment, but obviously larger questions loom there. And then industrial's been kind of like apartments in the sense that it's been a favored investment class over the past few years. But industrial, you also lock yourself into much longer leases. And guess what? If you don't have a tenant at that 400,000 square foot warehouse space, you're just without a tenant. But with apartments, even in a recession, you're looking at 90% of your units filled. I mean, I think that's starting to really sing to a lot of investors, and just that stability in that cash flow makes it an attractive space. Nevertheless, you see that rent rolls are growing at a really attractive level, 6%, 7%. We think that continues to move further up next year, as especially renewal rents continue to improve as well.
Carl, before you go any further, can you just to make sure we don't leave anybody behind, describe what a rent roll is?
Mm-hmm. Yeah, absolutely. So rent roll is basically looking at, of all your tenants that are currently at your property, what is their monthly rent? So, and that's a good point to bring up, Ray. I'm glad you mentioned it, because what you'll notice is that this number lags what current lease growth is, because somebody that moved in November of 2020, or I'm sorry, no, somebody that moved in November of 2021 may have signed a lease at $1,000 per month. Somebody that moved in today may have signed it for $1,015 per month, but it's going to take a little bit for your full book of business, if you will, to really show all those rents and how that balances out across 50 units, 100 units, 10 units, whatever that number may be. Yeah, thanks, Ray. That's a good point of distinction to make there. Now, getting into some of the drivers for what's caused, or what's lended itself to such incredible performance across the country. I think for one, if you look at renter incomes, those income levels have grown over the past year. And this is looking at new residents or new lease signees, what they are earning today versus what they were earning 1 year ago. And you can see that across the country, resident incomes are up to 72,000 on average, and that year over year, that's up 13%. So even though rent growth is up 17%, guess what? Income growth has also followed a pretty similar trend. Now, clearly, some of this is going to be inflationary. There's, we can't mention this number without mentioning some inflation. But if you look at some of the other factors driving this, you've got tight labor. Tight labor is lending itself to employers paying more to keep that qualified talent there. That lends itself to rising income. And you can see that there's other economic trends that are fueling some of that income growth. Now, looking at population growth, the colors on here probably aren't a surprise. The states on here probably aren't a surprise, but I do like showing this graphic because many of those markets that I showed earlier that are leading for rent growth, it's no surprise are also the states where a lot of population growth has happened. A lot of folks from Illinois and New York moving into Florida and the Carolinas, California, a lot of folks moving into Texas, Louisiana, same thing. And you can see where some of those demographic and population growth trends are really starting to emerge. Florida added, between July 2020 and July 2021, based on census estimates, Florida added 211,000 people in 1 year. Just incredible growth for the state, and only Texas surpassed that with 310,000 new residents. All right, so looking really quickly, I'll go through this part a little bit more quickly. This is looking at apartment sales volume. This is across the country. You can see that in 2021, let's call it roughly $350 billion worth of apartments traded hands. Not only was that a record, but that surpassed the previous record by 74%. And across all commercial real estate, apartments make up about 43% of all commercial investment. Historically speaking, that number was closer to, let's say, 20 to 25%. So to me, again, this signals that you have a lot more capital going into apartments. Many of y'all mentioned that there's a shortage of deals out there right now. It's not just you feeling it, it's everyone feeling that because there's so much capital chasing these apartment sales. Now, a really interesting note real quick too, is that last week at NMHC, probably the first time, certainly the first time I've ever seen this, but probably the first time a lot of folks have seen this. Generally speaking, leading up to this year, it was brokers chasing capital. Brokers were chasing, sourcing capital for these deals. Now you're actually seeing capital chase deals. You're seeing capital trying to, find the best way to allocate towards apartments. I mean, it's just incredible to see how this has shifted over the past few months, and really just shows some of these numbers you're seeing on the screen here, where some of that overall newfound investment interest is in apartments. And again, lending itself to compressing cap rates, lending itself to a lot of competition out there. And again, it's not just you that's feeling it, it's pretty much everyone that's active in the space. Now, Ray, you brought up a good point earlier that I wanted to mention real quick too. Regarding cap rates, we've seen cap rates in most markets compress over the past, let's call it year to probably 2 years. Now, what you're looking at here is the average cap rate by market under the metro name, and then it's grouped by how many basis points or how much is that cap rate compressed over the past 2 years. And it's not uncommon to see some of these properties trading for a 4 cap, in some instances even a 3 cap. And what I think that's doing is it's actually in some instances incentivizing folks to develop new. If you're going to be pouring all this into a value add asset, I'll use Dallas again as an example. If you're going to be pouring all this capital into a value add in one of those first ring suburbs, such as Richardson, such as Addison, why not move a little bit further out and develop new on the fringe of the town, the fringe of the market, especially now that you can get a little bit more flexibility working from anywhere. And I'll tell you, even here, I love this example just because it gives you an idea of today's landscape. About 10 minutes east of me, there's a town called Farmersville. Well, the town was named Farmersville because at one point it was way, way, way out there. Today, there's actually 2 or 3 investment grade big apartment properties going up, 300 unit garden style assets. And it just really shows you, it gives you a sense of scale of where development is heading. In Florida, you'll have to forgive me, I don't know some of the suburban names quite as well, but you'll see a similar trend in Orlando, similar trend in Tampa, maybe a similar trend in Sarasota, a little bit smaller, but you're starting to see that spread occurring as cap rates continue to compress further and further. Now, a couple of quick points here, looking at occupancy rates as we forecast for 2022. We are forecasting that occupancy comes down a little bit towards the end of next year, but the fact that we're still saying 96.5% occupancy is really, really strong. I do want to make the point that I think some folks that try to compare 2022 to 2021 maybe we'll get a little bit disappointed because it's not going to be able to repeat what we saw happen last year. But that's kind of like being upset at yourself because you're slightly worse at basketball than LeBron James. It's going to be impossible to repeat what happened in 2021. So 2022, we're expecting some moderation, some slight easing. Same with forecasted rents. I told you earlier that we're expecting about 10% rent growth in 2022. Anybody would have been ecstatic to hear that over the past decade. So I think we're looking at what we're starting to enter into some more moderation, some more normalization by market, or at least by major market. You again see some of those similar tiers start to develop. I'd point out Florida and the desert Southwest, excellent shape. The Sun Belt markets really look well positioned as we move forward into 2022. And we think that'll carry forward into 2023 and beyond even. Now, one last forecast slide here, looking at permit volumes. How much multifamily development do we think we get going forward? I think we see that number start to increase a little bit. We're forecasting 420, something like that, 1,000 units to deliver across the country this year. I think that number stays around there for the next at least 3 to 5 years. If you look at permitting for multifamily, we've got about 400,000 permits issued in 2021. You can see that really didn't take that much of a dip during the pandemic. And I think we continue to see that holding at 400 to maybe 450,000 permits issued. Now, on the single family side of the equation, you can see that we've still yet to get back to pre-Great Recession levels of permitting. And I'm not saying that we need to get back to 1.2 million single family permits issued per year, especially in some of these markets, such as the Florida markets, which were hit really hard by the great financial crisis. However, we're still a long ways from getting back to the supply levels that we need to support today's demographics and population growth. So to me, this sign here, this trend says that even though we're getting a lot of apartment development, there's going to be a lot of demand matching that. You don't have as many single family headwinds as you did, say, 10, 15 years ago, whenever it was a lot easier to get into the single family market from a home buyer's perspective. So all considered, looking at, and I won't go through all these in depth, but all considered, I think the outlook for 2022 is really excellent. 2023 to, let's say, 2025, things still look really good. Of course, there's always the risk of some black swan event None of us saw COVID, happening in 2019. So there's always going to be some risk of some black swan event happening. But barring that, I don't see the economy, or I should say, I don't see renter demand getting into a position where it slows down considerably. So that's our national overview. I do have the Florida markets to go through here. I got about 20 slides for that, but I do want to turn it over at this point for any questions.
Carl, how are you? This is Winston. Just have a question on supply issues. Do you think that supply issues will slow down some of your numbers at all?
Yeah, great question. So that's going to be one of the tricky things to really pinpoint this year, is how much those supply chain disruptions, labor shortages, et cetera, it's going to be difficult to pinpoint how much that slows things down. But I do think it's fair to assume that this number, I think we're saying, 427,000 units. I think that number comes down by 10 to 15% by the end of the year. It's hard to get people on site. It's hard to get labor, or it's hard to get materials on time. I've been hearing that from a lot of developers. So I do think that number comes down. That's a really good question.
Carl, quick question. I know you talked a little bit about going beyond 2022 and into even 2023. What do you see the headwinds of interest rates, or what will interest rates really do to potential estimates, if you will? I mean, a lot of people are thinking that, numbers are going to start turning, because as those rates start jumping up, it's going to really, put a little bit of a wrench on some of this.
Yeah, that's a good question too. And I think tomorrow there's actually one of the Fed meetings, if I'm not mistaken. So I think tomorrow we'll see the first signal for how the Fed feels about raising interest rates. I think the general consensus is that they will be raised 25 basis points, I think is the consensus. And, I do think interest rates increasing is probably one of those things that maybe is good for the long-term economic health. I think there are, some arguments to say that asset prices are a little bit heated right now. Maybe the stock market's a little bit heated. But by that same token, I think when you look at the demand story for multifamily, I think there's going to be so much appetite from investors, so much appetite from renters even, to keep fueling that demand, that I don't know that increasing interest rates, again, barring some 2 to 3% increase on interest rates, I don't know that that's going to be enough to really tip the scale in favor of a slowdown. Maybe you have some markets coming down from, 20,000 units to deliver to 15,000, but I don't think it's going to be enough to really tip the scale, and certainly not overnight.
Thank you.
All right. So any other questions? If not, then we'll just go ahead and jump right into the Florida markets at hand. All right. And it looks like I'm at 45 minutes. I'll assume another, let's say 20, 25 minutes, Ray, and then open up for Q&A. Does that sound good?
Yeah, that's great. I mean, we got time. So, and I'm sure if you need to go
Okay.
long, some people will stick around. It's worth it.
Perfect. Yeah, I just want to make sure I'm not eating up too much of everyone's time. Make sure I'm on schedule here. So what I've done here is I've plotted some forecasted numbers, looked at some annual supply numbers, revenue growth, et cetera, and then did a quick summary for each of the markets at hand. So again, I'm happy to pivot from this format if needed, but looking at first Deltona, Daytona Beach. And by the way, you're going to see this trends with essentially every market we look at today. I wouldn't focus so much on that slowdown. Again, it's going to be almost impossible for a market like this to get 17% rent growth next year. But I do think that if you look at this 2022, 2023 number compared to, say, the 2019 number that's showing, kind of gives you an idea of where that longer term norm, or that landing spot, if you will, is going to be. So Deltona, Daytona Beach, rents are up about $300 from where they were in February and March of 2020. Despite that, occupancy rates are excellent. Occupancy is 98% in this market. We do expect that comes down a little bit, but again, if you look at Deltona, Daytona compared to historical norms, I think that looks like a more quote unquote normal number. Now with Deltona, Daytona, one of the things I think that this market did a really good job of was weathering this big wave of supply that delivered in 2020. I think last time we talked, we had pinpointed that supply number as being a big headwind. 2,500 units delivering in a market the size of Deltona is a lot. I want to say that's like 7 to 8% of all existing stock in the market. However, the market was also offset with a lot of demand, and you can see that demand, the blue line, way outpaced what we saw from the supply front. Now, whenever you get into the forecast, and again, I wouldn't focus too much on that demand number in the outer years. In pretty much every market, that number is going to come down in years 2 and 3 of the forecast. But really what's happening is that when you have 98% of the apartment stock occupied, there's just not much room for demand to pick up. You know, you can only, demand has a finite, or I'm sorry, occupancy has a finite level of 100. So the fact that you can't grow occupancy above 100% means that demand is going to have to slow down, because that's looking at a net absorption number. I think if you look at demand from a non-mathematic perspective, in other words, just look at the appetite for renters, that number stays strong. So a little bit of a weird instance there. Whenever we look at our demand numbers, that forecasted number is really a forecasted net absorption number. It's not a demand outlook. Does that make sense? I know that's kind of a tricky thing to preface there, and I wish we had a different term than demand, but it gets used interchangeably with absorption. Now, nevertheless, looking at today's revenue growth, in other words, how much your rent roll has grown over the past 12 months, Deltona, Daytona Beach is up 11%. That's one of the stronger numbers we see in the country. Now, what's driven a lot of Deltona, Daytona's rebound? I think a lot of it is migration into the market. Just incredible stuff. Looking at a market this size, fewer than 700 units sit vacant today. That is just an incredible number when you consider the size of Deltona, Daytona Beach. Now, if there's a headwind here, I think it is this tourism-driven economy. We've seen tourism, it's still yet to really get back to where it was pre-pandemic. Maybe it never does get back to that full level, at least from a business travel perspective, but we are starting to see personal and family travel pick back up to more, again, quote unquote, normal levels. But because there is such a reliance on tourism in this particular economy, I think there's a little bit of limited upside in the grand scheme of things. I think Deltona, and you even see it in our forecast, I think Deltona, Daytona Beach has the potential to have a little bit of a rougher landing, simply because I think some of what you've seen over the past few months is migration driven. And again, the question is just how much of that's permanent versus how much of that's temporary. So any questions on Deltona, Daytona Beach? All right. And just a little fun side note here. I tried to get some clip art that captured the essence of each of these markets. So I want y'all to grade me on how these little clip art things, this was an easy one. This one was low hanging fruit, but I want y'all to grade me on my judgment of the Florida markets from a removed perspective. All right. I don't think we actually had this one in our last discussion, and I know Gainesville's kind of on that. Well, is it really Central Florida? Is it North Florida? But I did want to include it here in case anyone is looking in Gainesville. I'll keep this one pretty short. I think Gainesville, again, you see that trend where rents were getting cut last year, sudden surge in rent growth. I think one thing that hurt Gainesville last year is just that it's so reliant upon the University of Florida. And there was a lot of unknowns with what the 2020 academic year looked like. Now, granted, somewhere like Florida, 2020's academic year looked a lot more, again, quote unquote, normal than say somewhere in New York, somewhere in Boston, somewhere on the West Coast. But nevertheless, you saw modest rent cuts last year. Now that school is back in session, now that things are looking more normal, you saw a really solid rent growth. But Gainesville is one of these markets that just has it's so reliant on the University of Florida that I think there's maybe some, upside potential that gets capped. In fact, Gainesville is one of the least diversified economies in the country because it is so tied to the University of Florida. And as a result, we do have occupancy rates expected to moderate a little bit. You've got some supply that's delivered in 2021. I think that's going to ding occupancy rates a little bit. So that gives you a little bit of our perspective on Gainesville. Everything I said thus far almost seems doom and gloom relative to some of these other Central Florida markets, but even then you're looking at revenue growth of 7% year over year. So I think Gainesville's good. It's just comparison is the thief of joy sometimes, and Gainesville's maybe not quite as glass half full as somewhere like Tampa or Orlando, et cetera. Any questions on the Gainesville overview? And again, I wanted to keep that one a little bit shorter just because I know Gainesville's, is it Central Florida? Is it not? Kind of in that gray area. All right, so looking at Orlando, and I mentioned this earlier that Orlando was one of our surprise markets in 2020, one of our surprise markets in 2021. You could see that 2020 rent cuts were pretty significant. Residents moving in were getting about a 5% discount on their rents. You were seeing concession usage be utilized pretty heavily. But today, when looking at Orlando performance, you got one of the strongest rent growth numbers in the country, 25% rent growth. Occupancy rates have gone from 95% to almost 98%, almost overnight. The fact that a market like Orlando, consider how many units are in this market, the fact that occupancy rates increased 3% in less than a year tells you a lot of demand flew into that market. Now, a lot of that demand, in our view, was migration driven. You see that the Orlando economy has still struggled to really get back on level footing, at least when you look at a holistic economic story. Still some tourism jobs are lagging in the recovery period. But nevertheless, I think that migration story is enough to keep Orlando in solid shape through next year, or at least through next year, because you do have a lot of migration driving a lot of demand. And by the way, income growth in this market is strong, 15% income growth year over year, slightly above what we saw for the country overall. Now, if there is maybe a little bit of a headwind, it's that this supply number remains pretty big through 2022 and 2023. But again, when you've got this much demand and sustained demand at that, a big supply number isn't really too much of a deterrent for future rent growth, future occupancy. It can be in certain instances, and maybe it is on certain street corners for certain individual assets. If you're competing with a lease up across the street, similar price, similar year built, maybe that's a little bit of a different story, but just market wide, I'm not too terribly concerned about that supply number. Just maybe dock some points if you're there in Central Florida and some of those faster growth suburban areas. Now, Orlando, any questions on this particular market? And like I said earlier, Ray and I were talking, and just calling a spade. This was one of the markets that we were off on last year. We thought it would be slower to recover. We really undersold the demand side of the story in Orlando, but it's been good to see that this market has recovered as quickly and as substantially as it has. All right, now getting into Tampa. Tampa has been, at least in my view, one of the top 3 markets in the country over the past year to maybe even 2 years. Tampa barely slowed down in 2020. You see here that rents basically rent growth, I should say, basically went to 0% at the worst. And then that was super short-lived. By the end of the year, you were already getting 4.5% rent growth. That's only accelerated much further this year, looking at 25% plus rent growth. And look at this occupancy trend. I mean, again, almost overnight, you went from 96 to 98% occupancy. Really incredible stuff in Tampa. Now, something that I think has boosted Tampa further is, again, looking at the inbound migration trends. That's certainly been something that's really been strong in this market. But Tampa's economy has actually been one of the nation's fastest recovering as well. So not only do you have a lot of migration, maybe it's some of that work from anywhere trend, not only do you have a lot of retirees that have moved into this market, and retirees aren't going to be as susceptible to facing recession downturns, living on fixed income, that's going to be tied up and not susceptible to the economic ebbs and flows. That altogether, paired with the fact that the economy is still in really good shape, has pushed this market to just unbelievably strong territory. And look at this today. So comparing today's rents to the start of 2020, rents are up almost $400 market wide in really, let's call it a year and a half, maybe 2 years. So really, really good, strong performance in Tampa. Kind of counter to what I said in Orlando, you actually look at construction levels and they haven't dropped all that much in the past few months or the past few years. Construction levels have been pretty steady. So I don't think you're going to run into a lot of supply headwinds here. And then that last number, 13% revenue growth. I mean, just again, incredible performance for Tampa overall. And I see Tampa Bay Buccaneers, so that's all the this was the clip art that was the hardest to really pinpoint. So I'm glad I found one that worked pretty well for the market. All right, so looking at Lakeland now. Lakeland a little bit smaller, really good location in a lot of ways. Halfway, or let's call it roughly halfway between Tampa and Orlando. One of the things I really like about Lakeland going forward is that if you look at its economic makeup, it's a lot of transportation and distribution and warehousing jobs. That segment of the economy has been really, really strong throughout the pandemic. Online shopping barely slowed down. There's a growing need and a growing importance for these distribution style hubs. You go to parts of Dallas that are very, a lot of Dallas is very distribution hub oriented. There's 4 or 5 major interstates that meet here, located in the center part of the country. You go to a lot of those areas where those big industrial developments are, and the economy in the area is doing really well. Well, Lakeland overall is very similar to that, except it's most of the market. Now, maybe it's not quite as sexy as some of these other areas because you're not on the coast. Maybe it's not quite as there's some other parts of it that maybe aren't quite as appealing immediately. You don't hear about Lakeland as much as you do Orlando or Tampa, but I think if you really start to peel back the layers of the onion here, Lakeland has a lot of promise to it. Now, if there is a slight headwind in Lakeland's near-term future, it is the supply number. 1,500 units doesn't sound like a lot, but that is quite a bit for a market this size. However, I'm going to play devil's advocate on my own point here. Look at what demand did when a lot of units delivered in 2020 and the first part of 2021. Demand was more than able to keep pace. And I think this is a good example of, I won't go as far to say if you build it, they will come. But I do think this is one of these markets that new construction almost allowed for the release of some demand that was pent up. So I think some of these markets is important to remember that new construction can actually allow for the release of some pent up demands overall. Now, again, it's a smaller market, so some of these numbers are going to be a little bit volatile. And by the way, this is a slightly different data set than whenever we look at just rent growth and occupancy. I won't get into the nuances here, but overall, Lakeland revenues, really good shape. We think that this market's going to be in really good shape going forward. Lots of population growth, lots of migration into this market. So while there is some volatility in the outlook, just because the market is smaller and a smaller market just inherently lends itself to more volatility, I have a hard time really docking a lot of points from Lakeland other than that one perspective. All right, I think Sarasota, and I think I have one more market after this if I'm not mistaken, but let's look at Sarasota real quick. At one point earlier this year, Sarasota did have the nation's biggest rent growth number. It was basically Sarasota and Boise were kind of jockeying back and forth for number 1 and number 2. Now, this looks like a big slowdown in terms of rent growth. I know that's a steep slope, but keep in mind that you're going from 33 to 34% all the way down to 20% rent growth this year to the end of next year, 2023, 6 to 7% rent growth. I mean, just incredible numbers. Sarasota's had some of the best performance through the pandemic thus far. Occupancy rates barely took a dip back here in 2020. By the way, it's not, and this isn't going to be like a groundbreaking revelation for anyone, but it's not uncommon to see occupancy rates dip during a recession. A lot of folks will, double up. They'll move from a 1-bedroom to a 2-bedroom apartment with a roommate, save some money, make some more economically prudent decisions. But you can see that this trend was clearly short-lived as occupancy rates today sit at 98%. Maybe some volatility in the forecast. I think that there are some concerns about how much this new supply right here that delivered in 2021, how much of that was just temporarily absorbed, quote unquote, temporarily absorbed from migration versus how much of that's going to be permanent. I think Sarasota is one of those markets that, at least in my view, does have some risk from an outward migration trend. In other words, folks that maybe moved from some of the Northeast markets into Sarasota, are they going to stay there, or are they going to move back at a certain point? Sarasota doesn't have, and it's not to say that it doesn't have a solid economy in a lot of ways, but it doesn't necessarily have that mass of employers to the same degree that, say, Orlando or Tampa or even Palm Bay does. Palm Bay's got the whole Space Coast thing going for it, so maybe a little bit more of a risky reward play here in Sarasota or in Northport, but nevertheless, really good performance thus far. I love the portmanteau of Zoomtown. We heard Boomtowns has been one of these phrases used a lot. A prototypical Zoomtown, just work from anywhere. That's driven a lot of migration into this market. Now, last up, looking at Palm Bay, and I apologize, this is actually the Palm Bay forecast, so ignore that right there. But rent growth today, 22, 23%. Again, we think that moderates, but that just looks so steep when in reality, it's just kind of coming back to more normal levels. Occupancy rates look great. Now, Palm Bay, you'll notice that the numbers do moderate a little bit more substantially than what we see in other markets in Florida. I think some of that is also, Palm Bay is a pretty small market in the grand scheme of things. I think the model itself is trying to pull back this market to some longer term norms. It doesn't have as much history. The fact that it doesn't have as much history, it's harder to come up with more accurate forecasts in some regards. So I wouldn't put too much emphasis on these 2023 numbers, because I do think that those will get revised as we go forward. Again, it's just kind of part and parcel with some of these smaller markets. Nevertheless, if there is a short-term headwind, it is that supply number. 2,000 units is a lot for somewhere like Palm Bay. And sure, you've got some really good economic growth here. In fact, I really like the economic makeup of Palm Bay, because not only do you have the tourism economy, but again, you have that whole Space Coast thing going for it. I think that's going to be something that continues to grow over the next decade. But is it just a little bit too much construction in a little bit too short of a time frame? I think that's one of those, time will tell scenarios, but I think that's our outlook on Palm Bay. I think, again, it's not included in this particular deck, but Port St. Lucie maybe have some similar forecast expectations as what we're showing in Palm Bay. Obviously, the economies there are pretty different, but Port St. Lucie probably has some similar characteristics from a forecast perspective either way. All right. That is the end of my deck. I actually did pretty good because I'm right at 8:15, a little bit over an hour. So with that, I will turn it over for some questions.
Carl, do you think the bright line that's supposed to run, as we speak, they're kind of finishing up the Orlando run of that. That's going to go to the Orlando airport. That really connects Orlando, and then it connects the Sunrail that goes north and south, all the way from Deltona all the way south past Kissimmee. So you connecting that whole area, and now there are discussions about going all the way to Tampa, and that's part of what's happening. It's more about the route that they're going to take versus whether it will happen. What do you see from from your perspective if that were to come through? I mean, I think in my case, I would think that that would even drive more of this, this living anywhere, I guess, trend that we have, right? And do you think that that will make it even more so?
Yeah, that's actually really interesting. I haven't heard anything about the rail being essentially linked between the two cities. I would have to agree with you that if there is any sort of regional linkage, then that's going to be a huge benefit for that region overall. Orlando to Tampa is kind of in that weird spot of where it's just far enough apart that it's kind of a pain to drive, at least for like a regular commute. Now, it's not that bad for like a weekend getaway or, a weekend commute, but I think Cornelius said he's in Fort Worth, kind of the same thing here in Dallas, where from where I'm at to Fort Worth is like 45 minutes, an hour. It's just far enough to be a little bit annoying to regularly do. So, but having said that, if there was like a train between these two cities, then I think that would improve the overall linkages. And I think that would only help demand overall, especially within the context of some of that transit-oriented development for apartments that are positioned along those rail stations. Not typically as popular in a lot of the Sunbelt markets, but I think that could be something that would be interesting to see how that plays out should the broader scheme also play out.
I have a question, if it's okay.
Mm-hmm.
And do you see the Orlando Tampa market becoming similar to the Dallas Fort Worth markets, where it just kind of combined into one? And I'm not talking, in the next 5 to 10 years or something like that.
Right. Yeah, I think it would be interesting. I think the real catalyst there could be Lakeland, and just how much does Lakeland grow? And Lakeland itself may not ever be big enough to link the two directly, but I think that you'd kind of have that scenario where you leave a metro like Orlando, 1 million+ people, Tampa, 1 million+ people, but in between, now suddenly you have a metro of, I don't know, 300,000-400,000. I don't know what Lakeland is now, but I think that would be the real catalyst in between between those two areas. And I think that's also why I like Lakeland, is just it's well positioned should that regional growth continue in such a way.
Gotcha.
Is that right? Is that way that we can reach you?
Yeah, I'll put my information in the chat here. I'll do that real quick before I forget. There we go.
You made a good point. I know that there is supposed to be like a bullet train going from Dallas to Houston they're building on. So I'm pretty sure that can be more popular in more metro cities like this as well. Because
I'll be interested to see if that.
Yeah,
I'll be interested to see if that materializes.
They're also doing the Loop 9, which trying to wrap a whole highway around the whole DFW. So I wonder if it would be the same thing here as well.
Yeah, any sort of those regional linkages I think would be really good. It's just it's I love Dallas overall because at one point Beltline was like the original loop, and then it was 635, and then now you have like these loops around loops around loops.
Yeah.
Just crazy growth, and I think that's what the way Florida is in some regards. Maybe a little bit less so in South Florida. You're geographically limited in some ways. You can only grow north to south. You can't really grow east to west. But so like Maryland says, like San Antonio, some really interesting stuff.
Now I got a question. Now is there a lot of maybe I missed it about a lot of foreign the foreign influence? Because I know Texas, we got a lot of people from Mexico coming up. We got people coming from Oklahoma. So I'm wondering the same thing, but since it's with the water, like how is that affecting the market?
Yeah, that's actually something that's good to bring up too, specifically for Central Florida. And this was one of these things that was happening pre-COVID, but COVID accelerated it. What we saw was that over the past, let's call it 10 years or so, historically speaking, Miami and South Florida was a big destination for a lot of Caribbean relocations and a lot of Cuban relocations. But that market became pretty expensive. And we actually saw that a lot of the international migration that was going to Miami was now starting to pick up in Orlando and Tampa. So those two markets were getting a larger share of migration than they were historically, and that fueled a lot of demand, particularly for more workforce housing products, older products, especially more affordable products in suburban areas. So I do think that's been a trend that's fueled some of Florida overall, and is starting to fuel more of Orlando and Tampa in particular. Now, also on that point, a different perspective though, we've seen a lot of international investment bring up some of those investment numbers that I showed earlier. You're starting to see a lot of growth from cross-border investment into American multifamily product, and that's increasing some of that overall competition. So historically, maybe you were bidding against local investors. Now you're starting to bid against national investors, but on top of that, even international investors, especially in the single family space, maybe a little bit less so in multifamily, but certainly is still the case in multifamily.
Yeah, some would argue that Orlando is becoming a gateway market. I don't know if it's quite there yet, but it's getting close. You did have one interesting scenario or a thing that happened in Orlando that drove a lot of additional traffic and migration. You had a lot of folks from Puerto Rico that were really in dire straits with the hurricane and the earthquakes, and really the economy there suffered tremendously. And you had a lot of that movement coming straight into Orlando, Kissimmee area, that drove a lot of additional growth.
I got a question.
Yep, absolutely.
Okay. Ray, you said something about gateway market. What does that mean? When we say gateway market, what that mean?
Gateway markets are markets that usually foreign investors know. For example, Los Angeles is a huge gateway market for people that are coming in, say from China, from other places east. Miami is a gateway market for a lot of people in Latin America and other places, but they don't really know about some of the other internal markets. So when you talk about a gateway market, you're talking about those that are well known to foreigners and they're okay investing in them.
Okay, so like a gateway from
kind of like the University of Florida versus Florida Gulf Coast University. Like pretty much everyone knows the University of Florida, but only locals know Florida Gulf Coast, or maybe University of South Florida. I'm just throwing out names, but kind of similar example.
Hey Carl, this is Mohammed. I have a question. I'm sorry if I missed it, if you already talked about Clearwater area, but what are your thoughts on Clearwater multifamily there? Just in general, it's a vague question, but just picking your brains on that area.
Yeah, that's where, candidly speaking, it's a little bit tougher for me to comment on some, we call them submarkets, but it's a little bit harder for me to comment on some submarkets. Now, I have been to Clearwater, but not really from a work perspective. I've only driven through there on the way to some spring training baseball games. So a lot of my knowledge of the area is very, is going to be very limited. I do think something that Clearwater benefits from is that it's well located. And I think that's a positive for multifamily demand, multifamily investment overall, especially considering St. Pete in particular. You get a little bit of a different economic makeup, and that is going to drive a lot more Clearwater demand than Tampa proper is. And I think even that point could be expanded to where we're talking about Tampa overall in some of these slides, but I think you could make the argument that Tampa and St. Pete could be split and maybe talked about slightly differently. So that's where I would say that Clearwater may be more prone to following what happens in St. Pete a little bit more closely than what happens in Tampa, particularly downtown Tampa, or I know Tampa has like Ybor City, which is kind of like the nightlife district. I'm not quite as familiar with the St. Pete side of the market.
Okay, thanks.
Yeah, I wish I had a better answer, but that's I just have to be honest. I don't know quite as much about the submarket.
Yeah, no, that is helpful. Thank you. Appreciate it.
So Carl, bridge loans, what are you thinking? Two plus minimum?
Oh man, it's funny because I was talking to my boss about this the other day, and if if there's one thing that economists are really bad at forecasting, it's future interest rates. So it's tough to pinpoint that. Yeah, it's a good question.
Let
All right,
me ask a question on that note. Actually, Ray, you triggered a thought. I'm not sure who I was listening to a little while ago, and they were talking about Austin, and they were talking about how bridge loans are the only way to go over there because you just can't compete, otherwise you just can't get anything. Is that how you see Florida turning out to be in certain areas of Florida as well, where it's just or is it already there when it comes to getting your some profitable properties, and is bridge the only way to get in there, or is that just a good option to think about, or not yet? To Carl, or even Ray yourself too.
Sorry, I was keeping up with the chat here. I may defer to Ray on some of that. Now, what I will say with Austin really quick though, is that Austin, and I know that the joke is that Austin is becoming San Francisco South, but I think Austin actually does have, there is a very real trend of some political headwinds and political hurdles in Austin. There's a lot of NIMBYism, not a lot of there's a lot of not in my backyard going on, where certain developments are harder to get off the ground because the local city council just isn't quite as welcoming to it, and I think that limits some investment in some ways. I don't know to what degree Florida is like that, so that's where I would defer to Ray, or I see Martha leaving some good comments in the chat here, so perhaps one of y'all could offer some perspective for Florida in particular.
I missed the beginning of that, Mohammed, for the same reason. I was looking at the chat, but if I understand your question is whether bridge loans are the only way to get into certain markets, is that the gist of the question?
Yeah, and also, do you see some markets that are not there yet, getting to be there, maybe getting there fast? What are your thoughts on that? Yeah,
I would say that a lot of people that I know that get into bridge loan products are doing so because they're looking at assets that are, one, they're either new development, where a bridge loan is essentially a new construction loan, short term, because as soon as you flip that land over and it becomes something more than just raw land, you're able to refi out and based on the new value. And so you kind of do that a couple of times on the development side until you have your horizontal construction. So that's one reason that people do bridge loans, primarily on new development. Then on existing stock, a lot of bridge loans are related to value add products, because what essentially you have is you take out a loan and then you force value into that asset, and that allows you to refinance it later at a higher price point, pay off a portion of the investors or all the investors. And essentially you built some additional, almost like if you were doing new development, you're actually creating more value. But the question is, when you do that, you get into a bridge loan product, you're assuming that you're going to be able to force X amount of value there. Well, what if the value that you're assuming is lower than that? So now you run into a situation where you may not be really able to refinance and pay off that existing loan potentially, because that loan is going to include a certain amount of money for CapEx, right? You're not just getting money to buy it, but you also need money to renovate it. And so it gets a little bit trickier on that side of the house, especially as rates start going up, because that really starts driving down how much money you get back on a refi. Right. I don't know if that answers your question.
Yeah, it's a different answer to something I was also thinking, but that's very, very helpful. Thank you.
Yeah, that is really helpful. Thanks, Ray. That was interesting for me to hear too. So I appreciate you sharing.
Yeah, I just wanted to make a comment on not only as you spoke, and obviously it's the growth that Tampa in particular is experiencing and the sort of the joining that is happening between Tampa and Orlando with Lakeland being the center point, that as I'm looking at investments, we're not only, I'm in Tampa, so I'm looking at those towns like Clearwater, for example, they're just not playing. They're not keeping up with, modern days, although they have this beach, but they don't have a lot of anything going on there. But if you move up the coast to Dunedin and any of those small little towns, you will find, I was shocked to see how the prices are going up so fast. And so it's ripe for new construction. So if anybody wants to join up, let's get some land and get some more construction going on, because Tampa is busting at the seams. It's just completely saturated. And we're just going north. And of course, we're going to take Plant City completely out. That's Plant City is right between Tampa and Lakeland. And that town is going to kind of disappear, just as, Dallas, Fort Worth has become one, and those metro areas. And we keep going north because I-4 is a disaster. I personally drive. I'd rather go north to go south to get to Orlando than to take I-4, because I-4, it's a crazy mess. It adds maybe 10, 15 minutes to my drive, but it's a lot more peaceful. But I'm always shocked how much construction is going on up there for single family homes as I drive up on 75. So I would say that some of that land, that it's not cheap because the prices have gone up like crazy in the last 3 years, but there's certainly some room there for investment. But most of it is going to have to come with new construction because the structure is just not there. But people are, going further and further because the jobs are here. And, Tampa has done a great job, which I believe I met the guy who, I guess he came to working from Miami. He worked in Miami for like 20 years, promoting Miami and creating it to be in that gateway that you were talking about, Ray, Spanish guy from Colombia. And now he's here and he's been working Tampa for the last 5 years. So it kind of makes sense that now we have such a growth. And of course, COVID, I think, made everything go much faster and bigger because everybody wants to be here, given the fun town and of course our political environment that we have going on right now. So stop coming, but if you're going to invest, please let me know, okay? Because I like a piece of that.
We don't want to tell people not to come. Martha, come on.
Well, I'm saying,
we
don't
need
come.
that 1,000 a day. We need to keep coming.
Well, I think that 1,000 keeps going up every day, right? Thanks for the presentation. It was excellent, Carl.
Yeah, absolutely. Well, thank y'all for being a good audience, and always a pleasure to present to a group like this. It was good to see the turnout. I think we saw 23, 24 at one point, and good turnout. And appreciate the invite, Ray. And I left my contact info there. Feel free to find me on LinkedIn as well. So if you want to send me a message or ask any questions there, then happy to oblige. Thanks,
Carl. I really appreciate it. Again, a lot of good info, and I think what you'll have is a lot of people that are going to have to really study the slides, and then that'll trigger some questions like that. Do I had the advantage, if you will, to see the slides a little bit ahead of time, so I had a chance to kind of digest. But no, I tell you what, it's been great. It really is. Every time you get on here, and we may as well pencil you in for next year, Carl, and unless you become you get even bigger and you don't have time for us small folks anymore. But if not, I'm just love to have you again. I would tell the group before you sign off, Carl, that the next meetup for us is on the 21st of February. It's a normal third Monday of the month. This one was on the 4th. Just that I figured people needed to kind of recharge after the holidays, including myself. And so, yeah, we'll do that one on the 21st. We're going to talk about 1031 exchanges, talk about capital, right? You were talking about capital. That's one thing that people are, I'm seeing a lot more of, is people with these huge amounts of money, and they're trying to defer or kick that tax bucket down the road, and they're looking for places to drop that money in. And multifamily is in one of the places that they're going to do it, especially if it's a single family asset and they're, they got 200, 300,000. Are they going to buy another single family home? Probably not. They're probably going to jump into something. So we're going to talk to people about how to do that in a syndication or even in a partnership. So thanks again, Carl. I really appreciate it. And I'll let you know when this is jumping on YouTube, so you can kind of see it as well. And we'll push this out to as many people as possible.